Welcome to the Three Questions webcast series. I'm Wayne Baxter, Senior Executive Manager with One Capital Management. At One Capital Management, we develop and implement strategies that enable our clients to grow, protect, and ultimately distribute their wealth. We do that by offering investment wealth management services. Thank you for taking time to check us out. And if you enjoy this webcast, please consider liking this video and subscribing to our YouTube channel. Now, my clients are often referred to as cross-border clients. Why would that be? Well, it's because they're either U.S. or Canadian residents who invest in U.S. and or Canadian dollar-denominated securities like stocks, bonds, or ETFs. Now, regardless of whether you are a U.S. or Canadian resident, our process for advising our clients includes a discovery and diagnostic analysis of your wealth management goals and objectives. And as one would expect, that analysis would include a review of your real estate financing needs. On this edition of the Three Questions webcast, we'll be reviewing the 3 questions high net worth borrowers should ask about alternative financing options. Joining me from Woodland Hills, California is Ramy Zada. He's a senior loan consultant with Priority Capital Corporation. Now, Ramy's a LA native, and he's also an experienced second-generation real estate professional and specializes in structuring financing for each specific client. And what I like the most is he works closely with each client and their financial advisory team, which would be us, which I really appreciate. So, Ramy, thanks a lot for making time for us today. Really appreciate it, and look forward to our conversation.
Me too. Thank you, Wayne. I'm happy to join you.
So, now I know you're here in LA and in California and advise clients in California. Do you have the capacity to work with clients outside the state of California, or are you California only?
I'm really California only at this point. I was in the past, but right now I just focus on California.
Okay, great. So we're going to focus on California today and be specific to that. We got a lot to go over here today. Great, interesting topics and a few other probably little areas we're going to discuss. So let's get right to our questions. And we're going to focus on high net worth borrowers who maybe they don't have the typical easy to, fill out application for a mortgage. We're going to look at something called alternative financing, which I know is an area that you specialize in. So we're going to get right to it. And we have 3 questions from the perspective of that borrower. And the first one is as follows. I am a high income earner, but it's not reflected on my tax return. Can I still get a mortgage? The reason we ask that, of course, is that oftentimes people perceive that the way they get a mortgage, approved for a mortgage, is by having appropriate levels of income. So, Ramy, give me some thoughts on how they would address this problem, or how you would.
Well, in short, the answer is yes, you can get financing. It is alternative. Let's just define what traditional financing is, and that's the use of income taxes, basically, on residential consumer purpose loans. It's the last 2 years of federal income taxes that are required. Those loans are sold to Fannie and Freddie. Those are conventional loans that banks and lenders do. You've heard advertised ad nauseum the last few years. However, many self-employed individuals have their own types of tax returns that are either S corps or C corps or Schedule C, and they don't show any income because they don't want to pay taxes to the government. That's understandable. But then it's hard for them to get a loan. So how do they get loans with that? They have a great program called a bank statement loan. So what that does is lenders are able to use bank statements and use the deposits in lieu of the tax returns. So a lender will take the deposits on the bank statement. They'll look through the bank statement. They'll see these deposits based on their business. They will allocate a business expense factor. That business expense factor will be different based on your business. If your business has a lot of employees, if you rent a lot of office space, if you're buying and selling goods, you'll have a higher business expense than someone that, say, works at home, has only a computer, has a cell phone and a car, and no employees. They'll have a smaller or a lesser business expense. So they can extrapolate the income based off of the deposits and the business expense.
The cash flow from the business, the outflow of capital.
Correct. So they'll have a net income based off of the bank statement deposits and the type of business you have and business expenditures, which is in lieu of your tax returns, right? And your net income on your Schedule C or your S corp, so on and so forth.
So Ramy, is this 2 years as well, or is it longer, or like what's the rules on duration for the time frame for the?
Great question. So it can be anywhere from 3 months, 6 months, 12 months, or 24 months. Now, what is that? What's the difference there? 3 months, you'll have a higher interest rate because there's more risk. 6 months, higher interest rate, more risk, 12, 24, etc. So remembering that lenders lend on risk-based lending.
Right, 100%.
Yeah. So you have a longer, you can show more history. I've made this much money over 2 years. Hey, you're a pretty good risk. I'll give you a better interest rate.
Does that go out? Does that go to even further? In other words, is at some point, is there it's a diminishing return on like 5 years? Like, does it make a difference after you get past 2 years?
Not
Or
2 years, that's it. That's all they want to see. Nobody wants to go past that.
Showing 10 years worth of cash flow isn't going to get a few more points knocked off.
No, but you can actually use assets too. If you have a lot of money, right, they can, basically do an asset dissipation or asset depletion, in which, based on the age of the borrower, if you have 500 grand in a bank account, 200,000, $1 million, and the older you are, they'll be able to create an income stream based on those assets. You don't have to pledge them. They don't have to be moved. But the fact that you have them, right, they can say, and you're at a certain age, we'll create an income stream.
Well, I got to say right now, I mean, if someone is coming to us with $500 to $1 million sitting in cash, I can pretty well assure that we'll be putting it to work somehow. Obviously, after putting together a well thought out financial plan, but nevertheless. So,
yeah.
All right. So the good news is, even though you have a low amount of actual reportable income, there is still hope, providing you have the cash flow. You can prove cash flow, preferably over a couple of years of business activity. You can still get yourself some financing. So that's
correct.
Good. All right, that's excellent. Okay, so question number 2. I have a cash business. I think like laundromats comes to mind, or car washes maybe. I have a cash business, and as a result, I do not report much in the way of income on my tax return. How can I qualify for a mortgage? Mr. Zada?
Great question.
This is why you're bringing the high-powered experts here.
I love it. Bring it on. So that's another great question. What happens in this situation? I see this a lot, right? Where people don't really have the deposits in their bank accounts, right? They've got the cash and they're putting it under the mattress, or they're putting somewhere else, or doing this or that. Wherever it goes, they don't show it, right? So they can actually do what's called a no ratio loan. And that means there's no income and no employment documentation needed to show on the loan application. So in fact, you're saying, I don't have to prove I have a job, and I don't have to prove I have income. I do have to show that I have good credit, have a decent credit score.
You have to have a good FICO score.
Good FICO score. I'm not late on a lot of credit card payments, car loans, even my mortgage. I'm not late on it. I have good credit, and I'm going to put down 20 to 25% down payment on a purchase. It must be an owner-occupied property. I'll circle back to this. Must be an owner-occupied property. However, I do have to take an online counseling course.
Interesting.
And you have to pass this course. It's pretty simple to pass, but it's similar to a first-time home buyer's course. They want to make sure, and this is approved by the U.S. Treasury Department. Approved by the U.S. Treasury Department. You go online, you take this course, and you display the fact that you have been educated in this type of lending and being a homeowner. So there is no predatory lending.
Got it.
You're not being preyed upon. You are understanding exactly what you're doing and how this process works. You understand how the loan works, and you're able to get this. And this was done to help untraditional homeowners and home buyers, people that have good credit, have some money, but they're falling through a crack, right? They're not quite able to get this loan or that loan, but they're a good risk. And in fact, the default on these is very, very low. So they have a very small default factor. Many people use this in order to kind of be a bridge loan. Maybe they're starting a business, right? And they're really not showing that income. And they're able to obtain and purchase a property and 2 years later, they built up their income, they built up the loan, they can refinance and get a conventional type of loan. So that's another program that we have.
I find it really interesting, this idea of the cash business, and I can't help but thinking about the person showing up the bank with a wheelbarrow.
I'm not asking. I just get things in front of me. It's a great topic, because let me just say, as mortgage brokers, we are not the IRS. That's not our job.
Right.
We don't report to the IRS. We don't do any of that. We just give the information to banks and to lenders, and that's about it.
Well, there is a bit of a fintech issue about showing up with a little bit more than, say, $10,000 of cash. That's supposed to be a bit of an eyebrow raiser.
But that's going to be a problem too if they go to the bank and they
it's my Canadian naivety. What can I say?
You're so honest.
Which I know you can appreciate.
I do.
All right. So thanks. That's great. So there's hope for the ones with the cash business. Now, third, last but not least, I'm looking to purchase a for rent investment property. I think the key part is for rent, but I don't have enough income to satisfy conventional lending guidelines. How do I get the financing I need? Mr. Zada.
These are great questions, Wayne. I have an answer for you.
Good.
So there is a program called a DSCR, debt service coverage ratio. It's basically a commercial loan that's used for 1 to 4 unit residential rental properties. How does that work? What they're doing is they want to see the income that rental property takes. They want to make sure that income will service the debt on that specific property. That income will pay for the mortgage, the taxes, the insurance, and any HOA, plus some maintenance possibly in that property. As long as that income is enough to service that debt, you'll get a loan on that, regardless of kind of who you are. You still have to have good credit and so on and so forth, but they want to make sure they're making that loan on that rental property, that income can service that.
Well, that's really good news, because one of the actions that we have in our sort of our discovery process is we actually do very, very thorough, detailed capital forecasting. So if we generated that report that would show exactly what you just stated in terms of, here's the projected expense, here's the mortgage projection, here's the capital forecast, expected rent, et cetera, expenses. If we presented that, would that help strengthen the application?
Well, not necessarily. What'll happen is the lender will do an appraisal.
Okay.
The appraiser does what's called a rent schedule.
So the appraiser does it.
He does basically
regardless if we do it or not.
Correct. And they don't actually want that from you. The appraisal will say the property praises for this value based on these comparables on the value of the property. And he'll do a separate schedule for rents. And he'll say the market rents based on the comparables of market rents on the same property is X amount of dollars. It's $5,000 a month. So I say, as an appraiser, my opinion of value, that's what an appraisal is, an opinion of value. Mm-hmm. My opinion of value will be $5,000. This property will generate $5,000 rent. So that lender takes that and says, okay, appraiser says that's going to be $5,000 of rent. Your mortgage is going to be $3,000. Your insurance is going to be, $100. Your taxes are $1,000. And you have any HOA, it's this. So yeah, it works. This pays for that. So we'll give you the loan. That's kind of how that works.
Well, I guess we can reverse engineer the forecasting using the data that the appraiser finds. So we can work together here on this whole program.
Yeah.
So the good news is there's hope for those who want to become real estate investors and they want to get for rent properties. You mentioned though that there's a criteria, what are the criteria for the rental properties? We should probably maybe spend a little bit more time on that. So is there a minimum number of units? It would have to be more than one bedroom it's got to be like a rental property, like an apartment.
It can be, so we're talking 1 to 4 units. So residential
1 to 4 units.
Residential 1 to 4 units, meaning a single family home.
Right.
It can be 1 bedroom, 1 bath. It can be 5 bedroom, 5 bath.
Right.
But it can be a duplex, a triplex, or a 4 unit fourplex.
Okay.
Right? and there's no minimum in terms of square footage or anything like that. We are in LA, in terms of this marketplace. We know that rents are high. We know that, there's a shortage of housing, seems
Is
to
there
be
ever? Yes.
right everywhere. So that's really not an issue. But when you get into above 4 units, 5 units and above, you're commercial. That becomes apartment. Totally different. So we're talking about residential, 1 to 4 units. Simple.
I amaze myself with my ability to segue, and we've done that perfectly here because, in addition to being a residential financing expert, you're also, as we know, you also advise clients on commercial lending as well. And
Right.
I recently read an article in the Wall Street Journal on this topic, and I really wanted to pick your brain on this one. And I have no idea where this might go, but I read an article, I guess it was not a couple days ago, about the amount of commercial real estate debt that's coming up for renewal is like something like 1.7 trillion, excuse me, is it trillion
Yeah.
dollars over the next 3 years. And we're hearing more and more about this issue. It's across the U.S.
Yeah.
Issue that we're dealing with. We have banks that apparently don't seem to be too eager to lend. You've got tenants that appear not to be so eager to use or to even maybe renew. And I think to myself, is there an opportunity here, Ramy, or are we looking at like flat out another type of 2009 crisis that's like like the boat and the iceberg are like there's no way around it. So I'd
Well,
really like to get your take on this.
well, I appreciate that, Wayne. You made some really good points. I don't think this is quite Titanic. I don't think it's quite 2008. But there's going to be some hurt in the marketplace, and what's going to be hurt, and again, it's going to depend on the asset class of the structure of the building. Is it
Okay.
office? Is it retail? Is it a warehouse where Amazon, puts all their stuff in? That's not going to be hurt. So it really depends on the type of asset class that it is. We see that owner user things like medical buildings, people for doctors, dentists who are buying that. That's not going to be a problem with them generally. But you're looking at issues of say office buildings, right? People are not coming back to work as much. Other companies are kind of scaling down, and that's a kind of a separate issue than when a note comes due. So a commercial property, that loan is coming due, and that's going to come due this year. It's going to come due next year. That's going to be a problem because you're going from low rates to doubly high
Exactly.
rates, right? So those are the properties that may be in trouble. If there's no workout with the bank and the owner of the landlord of that property, that's going to be an issue. But we're looking at in the next 12 or next 18 to 24 months, rates are going to come down. So
That
notes
has to be the hope. I mean, there's got to be people literally saying their prayers every night, going, "Please, like."
Well, think about it. It was artificially pushed down by the Fed,
100%, no question.
artificially pushed up by the Fed. It's going to be artificially pushed back down, and then free marketplace is going to kind of take hold, right?
Yeah.
But we
I
do
guess the
know,
ones that are like 3 years out aren't worrying as much as the ones that are
correct,
reviewing in
or
the
five
next.
years out, or 7 years
Yeah,
out.
those ones is like, yeah, but
So that's
I'm
my
thinking
point,
more of the immediate term here.
right? But that's not 100% of them out there.
Understood. Understood.
That's why it's
But
not Titanic.
okay, fair. But
But
yeah,
yes, people
I
are going
was
to take
talking.
it, are taking a, they're going to take advantage. There's going to be a lot of interesting people are going to make a lot of wealth.
Well, that's what I'm saying. Is this an opportunity,
Yeah.
or is this, a colossal debacle? And because when there's a colossal debacle, somebody, what they say. I remember, was it Baron Rothschild, part of the 18th century Rothschild family, said the best time to invest is when there's blood in the streets.
Yeah. Well, what does Warren Buffett say?
Yeah.
I'm buying what everybody's selling. I'm selling what everybody's buying.
I have a few more of those. Exactly. We could probably get into the market corrections, or when stocks are returned to the rightful owners, is another favorite one of mine.
That's a good one. That's a good one.
Yeah, truer words are never spoken.
Yeah.
Well, listen, you know what? I knew you would be an awesome guest. I've been looking forward to this. Not only are you a good golf partner, you're also a great guest of the Three Questions webcast series. I guess really before we wrap up here, I think what we should probably ask is, for the folks here, maybe someone is looking to move to California, Ramy, or someone who is here in California who are watching the webcast today, what is the best, easiest, most efficient way for them to get a hold of you?
The best and the easiest would be either two ways. One, email, or two, my cell phone. As simple as that. And, I can give those to you if you like.
No, we actually are going to have those right on the screen. So the folks who are watching today, we're going to have that. I mean, we have your direct line. We have your email address already posted. So for the folks watching, will be able to do that. Again, I really want to thank you for making time for us today. You did a great job, as I knew you would. Ramy Zada is indeed an expert in real estate here in Southern California. He's a senior loan consultant with Priority Capital Corporation. Awesome guest. Ramy, thank you very much for joining us.
Wayne, thank you for having me, and thank you for everything that you do for my clients. Thanks so much.
My pleasure. It's all good. I look forward to bringing you the Three Questions webcasts, and I hope you find them educational and informative. Please consider liking this video and subscribing to our YouTube channel. And to receive a notification of when our latest webcast has been posted, please click on the notifications bell. Lastly, to schedule an online consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we'll see you soon.